Candlestick analysis uses the candlestick signals as well as confirming indicators to give you a high probability of when a trend has reversed. And that was illustrated today when, even though we had a very strong market, up 180 points on the Dow, it closed right at the T-line. Additionally, the stochastics have not turned back up. They're still heading in a downward direction. So the last major signal we had was a hanging man confirmed, and then we had a bearish doji sandwich that took us down below the T-line. Those still have to be the signals that are controlling this market trend until we have a bullish signal confirmed with a close above the T-line. So that with the Dow closing right on the T-line, this makes it a very important factor as far as how they open this market and trade the market tomorrow. Obviously, if they open it lower and start trading down, the T-line is still acting as an upside bearish or upside resistance level. On the other hand, if they open this positive and trade positive, that tells us more than likely this Morningstar type signal is kicked into effect and that we should be in our next wave to the upside. The S&P 500 also closed right on the T-line, but the NASDAQ came up, hit the 20, and closed well back below the T-line. Even though the NASDAQ was up 34 points today, it demonstrated there wasn't a whole lot of buying enthusiasm after the market opened. That's valuable information for letting us know whether this downtrend is remaining in progress or whether the bulls are going to start taking it back up in kind of a J-hook pattern. So once again, the open of the market tomorrow will be a good indication of whether the bulls are still in control or whether the bounce is over and they're starting to bring it back down. This still makes chart patterns that are bearish, such as our recommendation to go short on CONN based upon this dumpling top, that if they start trading this lower, breaking this level, we've got the potential of another big down wave. We obviously go with the flow. If the market trend appears to be down, obviously we want to have more short positions than long positions. But currently the market is still a market/sector specific trading market. For example, we had that slow curve on AMRI, and then it pulled back and doing a J-hook pattern. We were buying, and notice today that it consolidated and came back up. This means our wave 3 is still in progress. So whether the market's moving up or down, price patterns will still work very effectively because these are created by specific investor sentiment forces, and a J-hook pattern usually has another strong price move coming out after the first price move. And we also recommended OCLS coming out of this slow curve, moving up a big percentage move today. So the patterns work very effectively in spite of which direction the market may be going during any time of day or week. That'll be it. We'll see you in the chat rooms.